So I've been hearing some feedback lately that I've been speaking a little too quickly. So for this segment, I'm going to slow things down and talk at a more measured pace, and you all let me know if that works better. All right, let's dive into the broader economic situation we're facing today. With everything going on in the world, from the semiconductor industry to the rapid rise of AI, it's clear that many of the traditional assumptions about finance and global trade are being turned on their head. One of the major assumptions under scrutiny is the idea that the entire world supports U.S. sanctions. On the surface, this seems true. Many countries, especially smaller ones, feel they have no choice but to follow the lead of the U.S. However, the larger economies, particularly the BRICS nations, are not adhering to the U.S.'s directives, and this is a crucial development. The second major point is the mounting panic within the U.S. administration when it comes to dollar-based assets. The U.S. economy is so unstable at the moment that investors are on edge, ready to pull out at the slightest indication of trouble. Now, here's where things get quite amusing. Scott Besson, in a rather peculiar move, has resorted to posting storybook-style cartoons in an attempt to lure investors back into the market. One of the cartoons featured Franklin the Turtle buying US Treasuries. I mean, seriously, you can't make this stuff up. If US Treasuries were in such high demand, why would there be a need for a PR campaign featuring a children's storybook character to promote them? To understand the contradictions that Besson is trying to sell to the public, we have to look deeper. According to the Treasury, U.S. bonds are having their best year since 2020, with a 9% return year to date. But there are many ways to dismantle this claim. When interest rates fall, bond prices naturally increase, and the Federal Reserve has been lowering rates, but other assets have been performing even better. Take gold, for example, which has risen by 60% in dollar terms this year. On top of that, the dollar itself has depreciated by nearly 9% against other currencies this year. For global investors, buying U.S. Treasuries has been a fruitless endeavor, essentially a waste of time. What Besson is really trying to do is create more domestic demand for U.S. debt. The global investors have wised up, realizing that the dollar is in trouble, and the only buyers left are Americans. But here's the thing. The U.S. still imports a significant amount of goods, around 15% of its total consumption, so a falling dollar still has real consequences for Americans. Additionally, the trade war has pushed prices up significantly. This has led Bessent to launch an aggressive public relations campaign to protect the demand for the dollar. Without this demand, there will be no demand for U.S. bonds, and without global buyers, rebuilding the manufacturing base in the U.S. will become an even greater challenge. As I mentioned in the cabinet meeting yesterday, I believe that 2026 will be a pivotal year. The president has laid the groundwork: peace deals, trade deals, tax reforms, and now it's time to execute these plans in a productive way. The third major point I want to discuss is trade. These trade agreements are bringing in trillions of dollars, opening up new markets for U.S. companies, and bringing manufacturing back to the U.S. The agenda is simple. The Trump administration is making an all-out effort to push down bond yields. The steps being taken to achieve this are becoming increasingly evident. Every branch of the U.S. government is working towards this single objective. On the short end of the yield curve, you have Hazard, who's demanding rate cuts this month, calling for a 2.5 basis point reduction. Next year, he's likely to be the Federal Reserve chair, so we can expect even more rate cuts, potentially bringing rates down to around 2% by 2026. However, this pertains to short-term bonds. Besson can issue a lot of T-bills to save on interest costs, but the real problem lies in the long-term rates. The massive amount of borrowing in the tax sector alone could overwhelm the real economy. Remember, every dollar that goes into AI investments is a dollar that's taken away from other sectors of the economy. Every time a big tech company issues bonds, they are competing with the U.S. Treasury itself for investor funds. The amount of borrowing by big tech companies has skyrocketed. It has surged from under $20 billion to nearly $150 billion. Most of this comes from newly issued corporate bonds, with the rest coming from loans. The result is clear. Money is flowing out of the real economy and into AI data centers. Looking ahead, we'll need over $1 trillion more by 2030 to support this growth. This creates significant challenges for the administration. Rebuilding supply chains will require a massive financial investment, and there's no guarantee it will succeed. The revenue from tariffs is simply not enough to cover the gap. At the same time, Bessent is in a precarious position. Trump has promised a huge tariff dividend, one that could increase the national debt by $600 billion. Military spending, as we all know, is not likely to decrease. In other words, the deficit will only continue to grow in 2026. There's no room to increase tariffs any further without wreaking havoc on Main Street and U.S. manufacturing. Small businesses in the U.S. are already struggling. In November, small firms cut 120,000 jobs, the highest number since 2020. The damage is starting to accumulate because the effects of the tariffs are now compounding. In total, over 250,000 jobs have been lost in the past 7 months. Investors are not stepping in to help small businesses. All the attention is focused on companies like NVIDIA, AI, data centers, and big tech. It's truly a tale of two economies. This is where Trump finds himself trapped. Rolling back the tariffs is politically impossible. Without the expected trillions in revenue from tariffs, there will be no way to sustain the current strategy. Countries like Japan and Korea have no incentive to move their factories to the U.S. Additionally, the Treasury itself is predicting a large increase in government spending over the next 2 quarters, which will add even more supply of bonds to an already saturated market. In the first and second quarters, Bessent will be issuing $1.15 trillion in treasuries, $150 billion more than the same period last year. So the glut of bonds will only continue to grow. Some of these can be rolled into short-term bills, but at least 50% will remain in 2 to 10-year notes, putting even more pressure on the real economy. Therefore, more buyers for these bonds are needed, and this is where the BRICS and Asia have thrown a wrench into the plans. Demand for dollars is shrinking at an alarming rate. We've discussed before how demand for the renminbi is on the rise. Countries are borrowing and transacting more in Chinese currency, but it goes beyond that. Asia is now refusing to borrow in dollars. Instead, they are turning to the euro, which signals just how dire the situation for the dollar really is. Euro note sales by Asian companies and governments have hit 86 billion euros this year, marking a 75% increase. Euro issuance now accounts for 23% of the total, a new record. This trend of diversifying away from the dollar is becoming a global phenomenon. It's not that China or Europe are doing everything right, it's that Washington is doing everything wrong. We need to keep in mind the feedback loop this creates. More borrowing in euros means less demand for dollars. Therefore, the overall demand for U.S. bonds will continue to decrease. Besson doesn't want this to happen, but the growing deficits are keeping U.S. bond yields elevated. Plus, the volatile nature of the dollar adds another layer of unpredictability. Asian borrowers are finding it cheaper to raise money in euros than in dollars. After converting back to their local currencies, the savings can be substantial. Take, for example, SoftBank's loan. By swapping from dollars to euros, they save nearly 25%. This is a huge amount of money and a clear indication that a multipolar world is emerging. Why are countries borrowing in euros? Because the euro remains a reserve currency and its markets are still deep. While it will take some time for the renminbi to catch up with the euro debt markets, this trend is undeniable. Regardless, this movement is pulling demand away from the dollar. It's a disaster in the making. Besson finds himself caught in a downward spiral, trying desperately to defend the integrity of the U.S. economy and the effectiveness of the trade war. If investors don't buy into this narrative, the demand for U.S. debt will collapse. The curtain is closing on this chapter. But we're not done yet. What happens next? Treasury sales as a musical? Well, we'll see. Let me know what you think in the comments below. Will investors keep buying bonds, or is this the end of the line for U.S. debt? Stay safe out there. This revised version includes more detailed explanations and restructured sentences without changing the overall content.